the large jump in the non-debt job-creating flows of FDI into the country last fiscal in an encouraging sign in the wake of the challenges posed by COVID-19. The long-term foreign investment is reported by the State Bank to have spiked by 88% to reach 2.6 billion from the previous year. According to the bank's data, the power sector, telecom industry, and oil and gas exploration sectors have attracted the largest portion of fresh foreign capital, mainly from China, Norway, and Malta. Indeed, these are the second highest FDI flows into Pakistan in the last 11 years, yet it remains less than 1% of the nation's GDP and much below the real economic potential of a country of 210 million. Another major problem is the concentration of FDI is domestic oriented sectors, which in the long run has significant foreign exchange costs for the country in the shape of outward of profits, and given the long history of Pakistan balance of payments woes and its need to boost industrial output, especially for enhancing its exports, the country has always been looking to mobilize foreign resources, mostly in the shape of official assistance, since official bilateral and multilateral assistance has been increasingly scarce for the last 1 decade or comes with political and policy strings attached. Developing countries such as Pakistan are left with little choice but to muster long-term FDI as well as boost their exports and workers to support their balance of payments position.